currency crises, there have been many. We had our own in 1992.
1992, yes.
There was a 99 Southeast Asian crisis. There was one in Argentina. Turkish lira kind of went through its own version. Russian currency, they defaulted and they had a crisis. So just help us understand first, like, what is this currency crisis? And subsequently, let's talk a little bit about the 92 episode that we had and what we learned from it and what has changed subsequently.
Yeah, so currency crisis in general, I mean, basis the discussion that we had, is very easy to see that if you have an economic system which is very dependent upon large amount of imports, and you're not producing a lot of the stuff that you're consuming, but you're dependent upon other countries to actually import it, you will need a lot of foreign exchange reserves,
right,
to be able to do those imports, right? And if you don't have those foreign exchange reserves, you will have a very steadily depreciating currency, because you're just importing, you're not exporting, so value of the currency will keep on depreciating, right? Now there can be externalities which can accelerate this pace of depreciation. Market can lose confidence on the fact that you're just importing and you don't have any foreign exchange earnings, right? This in some senses is the core of a currency crisis.
So for whatever reason, basically there is a large exodus of money from the country, and that results in let's say a crash in the value of that foreign exchange of that country, which subsequently then means that imports become
very
prohibitively expensive,
right?
And there is then hence no food to eat or petrol to fill and so on and so forth, and that results in a more catastrophic social disorder.
Right. There is also an issue of confidence here, right? Currency crises are, they called a crisis because there is something that has changed about the market's confidence.
Correct.
Right? So, for example, if you are a large importer, as long as you have enough reserves, as long as the central bank has enough reserves, and the market has the confidence that you can continue to pay for those imports through the reserves, no crisis, no issues, right? It's only when the market loses the confidence in the fact that you have a lot of imports, you are dependent upon imports, something has happened to your exports, you are not able to supply as much exports as possible, and hence there is a sharp mismatch in the demand and supply, and the central bank does not have enough reserves to balance the demand and supply, which causes a crisis of confidence, right? So, the circumstances can be very different, trigger points can be very different, but if you actually strip away the idiosyncrasies and you get down to the basics of it, you will realize that ultimately it's all about, net demand and supply and ability of the central bank to stabilize the economy.
So let's go to
92. Yeah, so 92 is the same story for us. We were very import dependent. If you remember late 80s, India used to have, or right from mid 70s to 80s, India used to have this inward looking policy, right? We had this whole concept of import substitution. As an economy, we were not engaging with the rest of the world as much. We were not exporting as much, right? But we did have imports. Oil was still required for imports, gold was still being imported. So we reached a stage of point where our imports were far higher than our exports, and there was a steady depletion in the foreign exchange reserves that the central bank had, right? And we reached a stage and point where we had very, very little reserves left, and that's where the crisis, the confidence of crisis started, right?
If I remember right, there was some 18 days of reserves left at one point in
time.
That's
right, very, very small. I don't exactly remember the number, but it was a very small amount of reserves, and part of those reserves were in gold. And there was this whole story about how we had to physically move our gold and pledge it to raise some, dollars to pay for our imports. So that crisis actually created, it was a wake-up call. It triggered a very strong economic reform process in the early 90s, deregulation, focus on exports, creating a domestic manufacturing system which is internationally competitive, right? And then luckily in mid 90s we had this whole software exports story that kind of started. We became a hub for international IT investment and IT exports, and then the story changed from there. But the core is that today we have almost $600 billion in reserves, which means that over a period of time, we have more inflows than outflows, and the central bank has accumulated these inflows. So there's been a dramatic reversal in the last 20-30 years of story, but core of this is that import versus exports, right? How much is our dependence on external goods and services, and how much are we producing locally, and how much are we producing it for the rest of the world, right? Therefore, whenever you have a currency crisis, and it happened for us as well, typically you will see that the countries run to IMF or World Bank for a short-term loan, and one of the conditionalities that IMF actually puts on these kind of loans is to create a more competitive domestic industry, right, for export purposes.
Right. And Neeraj, this the fascination that we have as a country with forex reserves and many other countries as well, is it linked to episodes like this, or is it?
I think it's a very well-founded fascination, let me put it this way.
Right.
If you go back to 1997 Asian financial crisis, the sort of prescription for the Western world, from the Western world, and the organizations such as IMF and World Bank was that you should have a very open current account. You should promote a lot of free flow of trade across countries, and exchange rate will adjust and manage itself. It's like any other economic variable. But post 97 crisis, I think what people learnt was that markets may not exactly behave the way you would want them to. There are excesses that happen in an economy. In the Asian countries in the 97, what happened was the exchange rate was very elevated. In some senses it was very, the currencies were sort of over valued, and that led to a lot of borrowing binge by these countries. And when that borrowing binge stopped, and when the music stopped, there was a currency crisis. So now I think the current thinking is that given the volatility in the currency markets, and given the fact that these volatilities can create crises of confidence, having a good amount of reserves, particularly for developing economies such as India, is a must, right? So now no longer is the prescription to say that I have a fully open, fully convertible currency, let the market take care of itself. No, I think there is an expectation that the central bank should make sure that there is adequate reserves available, and in case there is a crisis or in case there is undue volatility, those volatilities are managed.
Right. So, I mean, this is a great point you made, Neeraj, which is that if you look at the South Asian crisis, basically that was driven by excessive indebtedness, which means that the economies borrowed and they spent it for something. That spending was not necessarily highly productive, and the borrowing was very cheap. But something happened in the external environment, and suddenly that cheap borrowing no longer was cheap.
Were available.
And then people said that, look, this country seems over indebted, and hence they pulled the money out. And our crisis was actually not of indebtedness; it was a trade related. Like we were borrowing, we were kind of buying, importing far more than we were spending.
Yeah, I mean, if you juxtapose it with what South Asian countries did, I think there was indebtedness, right? But if you create indebtedness, if you take on debt to create capacity, production capacity, which then turns into an export revenue for you, then you are effectively paying for that indebtedness, yes. Right? It's only when that doesn't happen, then there is an issue that whether the debt that has been taken is, from a foreign exchange standpoint, productive enough.
Correct.
Right? And while at an individual company level, the equation may be different, but you have to look at it as an aggregate economy level. Is our level of indebtedness something that we can sustain, right? Which is why one of the parameters that was started to become focus post the Asian financial crisis was short-term debt.
Right.
Right? The level of short-term debt. How much of short-term debt are you taking, and how does it compare with, let's say, your exports?
Right.
Right? Or a short-term debt as a percentage of GDP. What percentage of GDP is driven by the short-term external debt?
Right.
The point that I'm trying to make here is that at the end of the day, it's a currency market. It's a function of demand and supply. And if you are actually creating indebtedness, which is not going to result, so indebtedness is nothing but a future demand.
Correct.
Right? I am borrowing from you, using that foreign currency borrowings, I am going to do something about it.
And pay me back.
But at some point in time in future, I have to pay you back,
Correct.
which means that there is a future demand.
Correct.
So if I am not creating future supply of that earnings to match the future demand that I am creating by way of indebtedness, there is going to be a problem.
Absolutely. And it's two kind of reflections for me. One is that the foreign exchange crisis can be triggered by multiple things. It is not like one thing. But finally, it results in a crisis of confidence. It could be because imports are more than exports. It could be because of indebtedness. It could be because of some, credit default or whatever, right? Like it could be of many, many things, but results in crisis of confidence. And so that's number one. Number two, as a country, we have to be very thoughtful of how much debt, external debt we are taking, because that external debt, if it goes beyond a certain limit, could result in a
crisis
of confidence.